Welcome to Market Domination. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
This is a jobs report you want to take seriously, but not literally. The noise all over this report, it won't just be October, it's going to be November also. So essentially, guys, we're not going to get a clean look at the labor market until January of next year.
I don't think folks expect spend to taper off. This is an environment, if you look back in history, companies who maybe didn't spend ended up losing down the road by not being prepared for kind of the coming technology. So I think when you kind of hear commentary from Google, Meta, the spend is going to keep coming here. AI is this massive, massive opportunity. We're only a year or so into the opportunity. So we're probably looking at a very long runway of spend.
China macroeconomic weakness, China's about 15% of revenue. I think that's making it hard to determine if we're seeing a super cycle. And the other is that there was a mismatch in the timing. They had the new iPhone hardware out, but they didn't have the new AI software until more recently. There's a lot of noise in the data on whether or not we're actually in fact seeing a super cycle. And I think that's what's weighing on shares.
To go until the market close at the end of a very busy week. Let's take a look at the major averages here. We got a rally across the board here today. So a little bit different. We've been seeing a lot of mixed pictures, a lot of jumping around. But today we had two big stories, really. The macro story with the jobs report, and then what sort of you could call a macro story in some way with the AI and the sort of conclusion of some of the big tech earnings. All of that equaling a gain of more than 350 points in the Dow. The S&P 500 up about 0.6%. The Nasdaq up about 0.9%. As we see, let's talk first of all about the jobs report and percolating through the markets here today, Josh.
Yeah, I mean, interesting. Listen, we thought it was going to be noisy. It was noisy with the hurricanes and the strikes. What's interesting is it seems like, Julie, investors are willing to kind of look past that and through that and conclude that maybe the underlying trend, the big picture, as they see it, is still intact here.
Right, and that's also borne out by what we're seeing to some extent in the bond market. Now, on the one hand, yes, we did definitely see interest rate futures tick up, or tick down, I should say, basically pricing in a higher likelihood of a cut next week when the Federal Reserve meets. But at the same time, that it's pricing in more of a cut on that end, we're still seeing yields push higher, which is what we have been seeing on the outlook that the economy is still relatively strong. So a little bit of a confusing, I guess going back to the idea of noise, a little bit of confusion.
And still just a big topic of conversation there because you are so now near 4.4. What's the level that starts to concern you? What's the level where you think that presents a squeeze for the equity market?
And for this group in particular, talking about technology, just a quick look at big cap tech here on the day. Amazon helping lead up 6.4% here. We're seeing strength elsewhere, but not in Apple, of course, down 1.4% after some disappointing nuance in their numbers, including a forecast and what we heard on China.
Yeah, I'd point out Amazon. Also, Intel was really surging in today's trade as well. So big tech reporting, you have different responses and reactions from investors. We've got a very smart tech analyst coming up, help us kind of walk through the big trends and themes from big tech.
Yes, but in the meantime, let's talk about that macro picture and the interplay with the market. Stocks higher today despite those disappointing headline numbers in the October jobs report. For more on the latest data, what it all means moving forward, we want to welcome in Dana Peterson, Conference Board Chief Economist, and Michael Antonelli, Baird Managing Director and Market Strategist. Fantastic to see both of you. Dana, I want to start with you. I mean, everything from noisy to muddy was how I saw the jobs numbers today described. Do you think, as Josh was saying, that folks are sort of looking past it or trying to do you think people are sort of discounting today's numbers?
I think you should. We did have a lot of volatility there in terms of hurricane effects and also the strikes. And then we also saw a pretty big decline in temporary help workers. But that's been negative. We've been seeing negative prints for that indicator for almost 3 years now. So I think if you add back in the roughly 40 to 50,000 strikers, Also, you erase the effects of folks who were impacted by the hurricane, which was more apparent definitely in the household data relative to the payrolls data. I think you can say that, this report might not have been as bad, and that we should definitely look through it. One concerning thing is that we did see some downward revisions to prior months, but even still, when you added up payroll gains over the prior months, they were still very healthy.
Michael, let's get you in here as well. Now, we've heard from the economist on the panel. Want your take as well as the market strategist. What did you make of that jobs report?
I think Dana's right. It's certainly noisy. That tends to happen, by the way. We're talking about a statistical guess at a labor force of 180 million people. I love how we're always looking for certainty in that, even though it's basically impossible to happen. I think we need to look at some of the revisions, as was mentioned, certainly negative. But you know what? If you think about it, the labor force, it's probably stagnating. The labor force is probably slowing. I don't think it's catastrophically slowing. Temporary help softening, long-term unemployed rising, quits are softening. So yeah, if you were to look at the last 3-month average, you're certainly looking at a private payrolls that are probably stagnant. And I think that's on the Fed's mind. I think it's on the market's mind. But I would like to remind everybody watching that the market is not reacting to data from October of 2024. The market is looking out into spring of 2025. Let's remember that the U.S. stock market is a leading indicator. Employment is a lagging indicator. So I think more importantly is what is the stock market and the bond market saying about next year? Because those are the things that it's really thinking about.
Well, Dana, to Mike's point, it seems like if indeed it's a discounting mechanism, then it seems like that stock and bond market participants are feeling pretty good about the trajectory of the economy, right? I mean, are you on the same page? Do you think, say, if you look out to spring of next year, that the economic growth will still be maybe around where it is right now?
Sure, we could definitely have stronger growth next year, or even growth that's where it is about now in the third quarter, which was also pretty healthy. We'll see lower inflation, or at least stabilizing around the 2% target. Hopefully that will also include the core, and that core has been a little bit sticky lately. And also the Fed, we anticipate the Fed's going to lower interest rates pretty significantly, probably getting around 3.75 of a percentage point in terms of the target range by the middle of next year. That's going to provide some relief, certainly for any consumers who have been holding back on buying homes. Or, I mean, it seems like they are buying cars, but more people will probably buy cars. Also, it'll loosen up things for businesses who are certainly waiting for the election to be over to understand what that tax and tariff and regulatory environment will look like, but also if there's any changes in their taxes. And certainly once they know who's in office and what the composition of Congress looks like, they're probably going to open up their wallets and start spending, certainly as the cost of capital will be lower. So we are optimistic for growth next year.
Michael, another big topic, of course, for investors, and I was talking with Julie at the top of the show about that, is yields. I'm looking at the 10-year, Michael, we backed up here to 4.36. Is that a concern?
It's a really good question. And I was actually thinking about this very thing right before we came on. And I don't know if it's weird to have a strategist say, I don't know, but I'm going to default to a little bit of I don't know, because the 10-year went from 360 to 430 in basically a month and a half, which is a lot. That's a lot. And I grapple with it every day. What is it saying? Why has it gone from 360 to 430 in basically the month of October? I think my view, and again, I'm going to lean a little bit into I don't know. I do think that it's pricing in faster growth, a little bit better growth. I don't think that it's worries about the dollar or any of those like perma-bear nonsense things. I think it's a little bit more about accelerated growth, maybe tax cuts being being extended. I don't know, but in my view, the rise in yields it's important. And I think most of it is due to economic optimism, not some of the perma-doom nonsense.
Well, even if it is due to economic optimism, Dana, does it also complicate the job of the Fed? If they're cutting rates, and if they're trying to tighten financial conditions here, or loosen financial conditions rather, and the yields are rising and tightening financial conditions, does that almost conversely mean that the Fed feels like they have to cut more?
Well, I think the Fed is always fighting different pressures. They're fighting the market or they're fighting fiscal policy. But I think the Fed is going to be looking at the data. They're data dependent. And as long as they see that financial conditions on the whole are stable and they're not overly restrictive, then I think the Fed can feel comfortable cutting interest rates at a measured pace. So we don't anticipate any more, at least not for this year, any more 50 basis point rate cuts. We're thinking probably 25 next week and 25 in December, and they can probably go 25 until they get to some new normal, unless we have some big changes in the economy, like the economy slows really rapidly. But again, you have to think about what are the catalysts, and really markets need to get in line with the Fed. And that's what the Fed's been saying throughout this cycle of raising interest rates to address inflation, and now cutting interest rates to reduce the amount of restrictiveness. And the markets can fight the Fed, but it's better if they get along with the Fed.
Michael, another question to you. So you listen, big tech has reported. The reaction from investors different, right? I feel like it's a good time just to take a deep breath, Michael, get your reaction, your response to this earnings season. What did you learn? Actually, and what do you also forecast for corporate profit growth ahead?
Yeah, I think the reaction's been fine. I think it's been solidly fine. I don't think it's any sort of gangbusters. I mean, Amazon looks nice today. Apple, Meta, NVIDIA, they seem to be on track to executing their business models. They don't. None of them are saying anything that would lead me to be concerned about the next few quarters. I think profit growth, earnings growth is the reason the stock market's going higher. Everybody fights me on that, but it is. Forward earnings continue to move higher. So that's the one thing that seems obvious, but nobody ever wants to point it out. Earnings in and of themselves are doing fine to support the stock market. If the economy reaccelerates, you get a little bit of a tailwind from there. Look today, consumer discretionary is doing great. Tech's doing great. Healthcare, financials, industrials, all the kind of sectors you'd want to see higher on a day like today. And I've been looking at indicators all the time. I look at them every day, and nothing in the earnings realm is flashing any warning signs to me. But again, let's remember that the stuff that will hit the stock market will never be seen in advance, right? We know that the surprises are the things that the stock market hates. So we're going to try to hope to avoid some of those before the end of the year.
So before we let you go, let's talk about an event that we know is happening next week that could end up being a surprise, I guess, to someone, although we've talked about all the potential outcomes. Mike, I'm going to start with you on this one. The election, of course, is what I'm talking about. And I know you're sort of a stocks go up guy right now, to oversimplify perhaps. What is the riskiest scenario in your view for the market related to the election?
Oh, you threw me for that one. What's the riskiest situation? Well, here's what I think about elections in general, okay? Just Mike Antonelli's strategist's viewpoint, how I engage with clients. I like to remind them that the reason the stock market goes up over time, okay, is that the people that work at the companies go to work, make products and services, and shareholders get to benefit from that. That's a pretty easy model to understand. And I tell people that, yes, no matter what happens, no matter who wins, your neighbors are going to work. And they are going to work at Boeing and IBM and Caterpillar. And so I do think, yes, stock markets go up over the long run. But the riskiest scenario, I think, would probably be a situation where it just ends up in a deadlock, and we enter this kind of volatile state where it has to be kicked around in unusual ways between the various kind of entities that we have that decide elections that are deadlocked. But again, I'd like to remind everybody watching this and everybody who ever hears this that the United States of America has all sorts of crazy elections. We always have. We don't have this kind of unbroken streak of really super seamless elections. It does tend to happen from time to time, but I think just the riskiest situation would be one where we just don't know the winner even a month later. That would be probably the one scenario.
Dana, same question to you about the election. Just as an economist, I'm curious, when you hear from your members there at the conference board, what are they asking about when it comes to the election? What's top of mind for them?
Well, we do speak with the largest businesses on the planet, and they're very concerned about what the tax regime looks like for them, whether corporate taxes are going up or down. What does it mean for things like GILTI or global minimum tax? They're also concerned about the regulatory environment. Is there going to be more regulation or less? And then finally, tariffs. Tariffs are on everyone's mind. Certainly, tariffs were put into place in the U.S. on China back in 2018 and 2019. They're still there. It does have an impact, but folks are curious to know, well, are we going to see even more tariffs, which can certainly weigh on growth domestically as well as abroad and raise inflation, especially for consumers who are going to be buying those more expensive goods. So I think those are things that businesses are thinking about right now, and they can't wait for clarity on what the landscape will look like.
Dana, Michael, thank you so much. Have a great weekend.
Thanks.
We're just getting started here on Market Domination. Coming up, we'll speak to an analyst on the other side about the growth in cloud business we're seeing among big tech this earnings season. We'll not just be talking about Apple, but really all of those big tech companies. And also, former St. Louis Fed President James Bullard is here. We'll get his take on how the Fed may view the latest jobs data and what it could mean for Thursday's key rate cut decision. And as we turn the calendar into November, be sure to save the date for the 2024 Yahoo Finance Invest Conference. That's November 12th, starting at 8:30 a.m. The best and brightest minds across various industries, all under one roof. You don't want to miss those conversations. But in the meantime, stay tuned. More market domination still to come.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Several big tech names have provided their latest quarterly results, many reporting higher spending to capitalize on that AI play. Amazon, Microsoft, and Alphabet revealing they spent a total of nearly $51 billion in CapEx. That is up from the $30.5 billion in the same period last year. As for the benefits from all that AI hype, all three companies have seen revenue growth in their cloud businesses, potentially an encouraging sign for big tech. Creative Strategies CEO and principal analyst Ben Beharin joining us now to discuss all this. Ben, it is always great to see you on the show. I did want to start with Apple, Ben, because you know that company so well. And I was talking to Apple CFO Luca Maestri, and I asked Luca about the rollout of Apple Intelligence because it's different, right, Ben? It's gradual, and I was trying to ask Luca how he thought that kind of gradual rollout will affect the iPhone upgrade cycle. And what Luca told me was that basically it's tough to predict because, as he said, listen, this is different for us, this kind of gradual rollout. But yes, it could ultimately mean a different kind of cycle. Is that how you're thinking about it, Ben?
Yeah, I mean, I think if you look back, and this is a consumer point, I know we're going to talk about enterprise AI in a little bit, but from a consumer standpoint, it's been hard to look back on, the history of a couple decades of consumer electronics and really see software itself drive a hardware cycle. It's typically been very hardware driven. And I think that's the hardest comp that many of us are having to make, is to really look at how much of a software angle is actually going to drive a hardware cycle when we're kind of like, that's not really a comp that we've had before. So I think the unpredictability of it is definitely right on. I mean, I do think there's elements of coming. I think Apple Intelligence is the most mature kind of consumer AI implementation at a system level for customers. I think Apple's now got to go market and tell that message and make it, clear to consumers why they're going to want to use these features. And that's where I think we just don't feel that pull yet. We're not seeing people line up or have drastic FOMO, right, from hearing what their friends use Apple Intelligence and then they don't have that on our devices. So I think another few quarters are needed for that. So I think they're right in kind of the conservative rollout approach. But again, I sort of go back to, we just don't have a fundamental comp where we can see that a software, in this case, an operating system integration, actually drives a hardware cycle.
Ben, I'm going to get personal on that front for just a second because I have a 15, right? So I don't need to buy a new phone. I put Apple Intelligence on my phone. It's fine. I don't really know what to do with it yet. Like, is there something about it that you think will prove most compelling to users that will then drive that upgrade cycle maybe over the next few quarters? Like, is there something within it that is the killer thing?
I think it's really hard to point to. I think you make a very good point. And I also think it's important to note that the vast majority of humans who use this technology, they use smartphones and PCs, are not using any AI on a daily basis. I think we've got all of the hype that we talk about is really about power adopters and early adopters, right? People who are on the front end of that adoption spectrum. You talk to folks, just out on the street, normal consumers, they're not using any of this stuff. So in that regard, Apple's actually relatively early, right? They're in a unique position to onboard and help mature experiences with this software. And that's kind of new. They haven't really been in this category before of taking what we'll consider a bleeding edge technology and start to get people to care when it's really their first experience with it. So I think you're exactly right. This is an onboarding question. It's how easy is it to discover and use? These are user interface functions that I think they're up against, and to some degree, just philosophical approaches to how Apple does software. Like I said, I think they've implemented it in a way that should meet its expectations. But I also think I worry that people are coming from either too high of expectations or really no expectations at all, because it's not really a driver for them, right, to go and want to use these devices.
Ben, let's switch gears. I want to talk about the big cloud giants, too, because they've all reported now, Microsoft, Amazon, Google. What did you learn, Ben, from those reports about just the current state of the cloud market and the cloud wars?
Yeah, I mean, I think you've got two ways to look at this. I still think that there's outsized expectations for these companies in terms of their forward growth. And I think that's why you see some of the pullback that's been the case if a guide was not up to what sort of the expectations were. I think everybody's really waiting to see the software economics of especially the big cloud providers start to play out, and we're just not seeing that. I think the other important part about this is when you look at what their spends are in terms of the next year, this is still a very training heavy market, right? We're not really moving to mass inference yet, at which point I think, again, the economics might move more favorably in their favor. And a lot of that's going to depend on when organizations move from pilot projects of AI into mass deployment throughout their corporation. And from all checks that we've heard with CIOs and CTOs, that's not going to be until mid next year at the earliest, if not end of 2025 and into 2026, where we'll see that cycle. But the spend
I guess we lost Ben's audio there. So hopefully we can get back to him very soon. Ben?
Not sure why it muted.
Oh, there, we got you, Ben. We got you back. Do you want finish? Let me
Yes.
actually finish you quickly on this. So we were talking about the big spend on the part of the hyperscalers. I'm also curious. All of them are still posting comfortably double-digit growth in their cloud revenue. How long is that tail? How long can they keep up that pace of growth in those businesses?
I think the big part of this just comes back to when we move from training to inference, right? You're still seeing this be a heavily training-driven dynamic. Once that moves to inference, I think that's where we'll start to see more of those dollars get distributed in new ways. Because again, right, these companies are going to move from a small number of projects and pilots within their organization to deploying them to hundreds and hundreds of thousands of employees, right, and millions of people in the enterprise across the board. That's going to drastically change the software economic cycle. I'm not sure how much we project into that given where we're at in training. But I think the thesis is that when those organizations move to mass deployment, you'll actually see more and more of those dollars come in and potentially either a sustainable growth rate like you've shown or even more of an uptick take once you now move to full-on deployment within enterprise AI.
Ben, good to see you. Thanks so much. Appreciate it.
Good to be here. Thanks for having me.
Thanks. Now time for some of today's trending tickers. You can scan the QR code to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, we are watching a company called Global Star. Now that stock is surging, Apple related as well, by the way. Apple's set to invest up to $1.5 billion in this company. Now, most of Global Star's network is already used by Apple on its phones. So this is sort of an expansion. Apple, remember, has that emergency satellite texting on its iPhones, which is through Global Star. So this is sort of an expansion of that agreement between the two.
Yeah, it sounds like Apple's going to invest $1.5 billion in Global Star per Reuters to fund the expansion of its iPhone communication services. You can see shares of Global Star trucking higher today, but it has been a rough move. Just pull back the chart there. Apple commits apparently $1.1 billion in cash, also purchases 20% equity in Global Star for about $400 million.
Yeah, I think that as much as anything, the equity stake is probably helping matters there.
Yep. All right, moving on. Let's turn to Chevron and Exxon Mobil. That's after both companies' top earnings expectations in the third quarter. So just looking over the results here. Both Exxon and Chevron beat the street's profit, output, and sales forecasts. Sounds like generally rising oil production, Julie, from the Permian Basin. That's helping out with weaker crude prices. Exxon, best performing oil major this year. Of course, lots of folks in these names are in it for the capital return. Per Bloomberg, Exxon increased dividends for the 42nd consecutive year to 99 cents a share. CFO telling reporters, by the way, Exxon was able to fully fund dividend payouts and share repurchases with cash flow without resorting to debt.
Yeah, although Chevron, though, on the flip side, also still maintaining its cash payouts, but its payouts exceeded its profitability. So but the company has said in the past it's willing to borrow in order to meet those commitments. Interesting, we're seeing Exxon lower, Chevron higher today, because Exxon does seem to be also performing here if you look at the numbers. But Chevron has been more in sort of cost-cutting mode and trying to turn some things around here. Of course, the other thing that's hanging over Chevron is it is trying to acquire Hess.
It has this arbitration battle now.
Exactly, which involves Exxon because it has to do with some developments off the coast of Guyana. So just a lot still going on between these two companies. And it's not, what I think is clear is that it's not just a straight line from higher oil prices to higher profitability and stock prices for these companies, because it has to do with how much they're drilling and at what cost they're drilling. Exxon is actually getting low-cost crude out of a lot of its.
And certainly year-to-date, investors have placed their bets. I mean, just pull up the compare and contrast those two.
Yeah,
It's
definitely.
stark.
Also want to look at shares of Abbott Laboratories and Reckitt as they get a legal win in a one baby formula lawsuit. There are lots of these lawsuits that have been filed against the two companies. So this is one, though, but it was a surprise. It had to do with the death of a premature infant, and the parents of that infant alleged that it was a formula that was given to this child in the hospital. A court said no, that is not the case. They found for the two companies. And again, this was a surprise finding, which is part of the reason why you see the reaction in the stock.
Yeah, I saw analysts from JP Morgan cited saying just that investors have not been expecting a win here, which explains maybe the pop. They think it could decrease the total liability, by the way, for Abbott by somewhere between $500 million to $1 billion.
Yeah, and we're talking about liabilities overall from these cases in the billions. That's what's been estimated.
All right, coming up, while the election may be top of mind for investors, a key decision is coming from the Fed next week. We are speaking to former St. Louis Fed President Jim Bullard on the other side about what to expect from the central bank. Stick around, much more market domination for the come.
The market shifting focus to next week with two key events on the horizon, the election And the Federal Reserve decision, the main economic data for the central bank to consider next week in the books, but it was a mixed picture and leaving some questions as to what the Fed's next move will be. Joining us now, Jim Bullard, former St. Louis Fed president, and Dr. Samuel L.R. Allen, dean of the Mitch Daniels School of Business at Purdue University. Jim, thank you so much for being with us. We really appreciate it. So, as we said, the data has been mixed. We keep talking today about today's data that was noisy, it was muddy, it was confusing. What does the Fed do with all of the data and how it might interpret it?
Yeah, it was a low number today, but everyone knows that this was affected by hurricanes and by strike activity. Governor Waller of the Federal Reserve Board said before blackout that he thought maybe 100,000 jobs would be obscured because of those events. So if you add 100,000 back in, you get to 112,000, which still isn't all that big of a number. But if you average then from the last jobs report, which was higher, then you get something that's probably in the range of the truth about the run rate for the U.S. jobs market. Also, I think other indicators don't seem to be indicating any fall off in labor market activity. So it looks like the Fed's really on track to look through the noise and continue toward a 25 basis point decrease in the policy rate at the next meeting.
Do you think, though, Jim, because it won't be just this metric, I'm sure there'll be other economic indicators we get that, maybe seem a little noisy, a little messy. So are central bankers operating in a bit of a fog here, and they have to kind of hope that on the other side of this fog, the underlying trends just haven't shifted much?
Yeah, I think it's probably a bit of an illusion that the fog will ever go away. There's always quite a bit of uncertainty in this world. So you have to do the best you can to try to extract the signal from the noise. But we have other indicators, and GDP, for instance, has come in ahead of potential, faster growth than the potential growth rate, both in the second quarter and now in the third quarter. So it doesn't really look like we're on the cusp of any kind of recession or anything. So I think we have pretty good overall economic performance. And I think we can look through this jobs report and conclude that the labor market is still doing relatively well. Unemployment, for instance, staying at 4.1% in this report. And then, I think the committee is in pretty good shape to continue on its path to try to get inflation all the way down to 2%.
And where are you? We always like to talk about landings, what kind of landing we're going to get, Jim. I'm curious where you are in the landing camp, what kind we'll have.
No, I've been a big advocate over the last 2 years that we could achieve a soft landing, and I actually think we have achieved a soft landing. You can't really expect all of these numbers to go exactly to their long-run values. Inflation exactly at 2%, growth rate exactly at 2%, the unemployment rate exactly at the natural rate of unemployment. So I think we're pretty close on all those metrics, and so I think we have achieved a soft landing. And now going forward, other things will happen. Who knows what kind of shocks will hit the U.S. economy in 2025, and there'll be something new to worry about at that point. But I think the committee has been very successful, and Chair Powell's been very successful in getting inflation down from a peak, which the CPI inflation was actually over 9% at one point. Now it's way down from that level, and they'll be able to zoom in to 2% as we go through 2025.
When you think about those potential shocks next year, Jim, what could be some of those risks? What would be on your wall of worry there?
If you could predict the shocks, I guess it'd be a different world. But geopolitical risk, of course, has been high. I think it's in the headlines every day. We kind of know that these wars are out there, but they could get much worse, much faster than maybe people think. And that would have to be taken into account. That can cause other kinds of supply disruptions, which could affect the economy. You've got possible fiscal activism, I think, in the U.S. How is Congress going to try to handle very large deficits that have been accruing over the last couple of years? I think these are the kinds of things that you'll have to assess in 2025.
And Jim, something that we have to assess next week besides the Federal Reserve meeting is, of course, the election. And, we've talked with a lot of current former members of the Fed who talk about, sort of leaving politics outside of the door. That said, what about the economic implications of each candidate? Is that something, depending on next week's outcome, that the Fed might discuss?
I think that you do leave the politics at the door, and politics doesn't enter into the decision, but the policies, the fiscal policies, do get assessed by the Fed for their impact on the U.S. economy, and for that matter, what the other economies are doing around the world, what their fiscal policies are, and how that's affecting U.S. economic outcomes. So all of that gets computed and will continue to be computed. I would say a couple of things on this. I would say if you take your model and you put in a higher tariff rate for one country or another country, and you simulate that going forward, that usually doesn't cause that big of a impact on macroeconomic outcomes. However, the trade war that occurred in 2019, I think, where China and the U.S. were really bickering and investors weren't sure what to think, that can have immediate impacts on the economy. So I think, if you think about somebody that's trying to do a big investment in one country or the other, and they're not sure what the trade relationship will be, they're naturally going to want to pull back from that decision. So I think that's maybe the thing to keep an eye out for in 2025 if we get into that kind of 2019 situation, which we had for a little while. And I do think that caused some slowdown in the U.S. economy in that year.
Well, and by the same token, Jim, okay, let's just, come out and say Donald Trump has talked about raising tariffs, right? So that's a potential, and the trade war happened on his watch. So if he wins, and if he carries through on those policies, is that then a curb on the Federal Reserve's ability to continue to cut if those policies are going to be potentially inflationary?
Yeah, I mean, that year we did react in the middle of 2019 and lowered the policy rate somewhat, although not a huge amount, but somewhat during 2019. I think that was actually a pretty successful policy. In 2025, it looks like you still have inflation somewhat above target, so the committee would have to make a judgment about what they wanted to do in that particular situation. I would also say this: I mean, I think the betting markets have it about right. Trump's about a 60% probability of winning here, but that still leaves 40% for Harris, and we'll see how the election comes up. But I think it's razor close, and many of the political analysts are saying exactly that it's really pretty much unpredictable going into election day.
Jim, thank you so much. Great to catch up with you before that important meeting and the important election next week. Thank you.
Thank you.
Let's check in on a few other trending tickers. We start with Avis Budget. Those shares seeing a nice pop in today's session. That's after the company's upbeat commentary on the outlook for the holidays. And it had to be the commentary because the numbers themselves weren't so great. Revenue missed, adjusted EBITDA fell 45% and missed estimates as well. But it seems as though the company is a little bit more positive on what's coming next.
Yeah, we should know. I mean, it's the stock's up today, but this one has been a total mess.
Yeah.
I mean, it's down about 45% this year. But to your point, yes, I mean, I think it was that commentary. They talked about the holidays look strong. They talked about, listen, we're well positioned to capitalize on this demand. They were saying vehicle utilization improved by approximately 2 points throughout the company. We exercised strong fleet discipline, they said. So a nice pop today.
And one more thing, or actually 2 words for you, short squeeze is also what's likely going on here. 18% of this company's float is shorted according to Bloomberg data. So, that's definitely something that could be playing a role here as well.
All right, another one here. Madrigal Pharmaceuticals shares surging as Novo Nordisk shows results of weight loss drugs in patients with a liver disease. This is interesting, Joyce. There was a couple, we got a couple different headlines here. So this one, Novo Nordisk says, okay, Wegovy helps treat an obesity-associated liver disease in trial, saying it affects, Novo saying it expects to file for regulatory approval the first half of next year. And this, of course, has been a big part of the obesity drug story, this idea they help with more than just losing weight, and we saw these knock-on effects with other names as well.
Well, and what's intriguing about this is Madrigal makes a competing product, or is developing a competing product. It recently got approval for it. It's called Resdifra. So you would think that this would not be good for it. However, one analyst, for example, over at Piper Sandler says this raises awareness of this particular disorder, and so then it might get sort of funnel more patients even into Madrigal's product. There was also some talk about analysts that there are nuances that the Madrigal drug addresses that GLP-1s and semaglutide, which is the drug that Wegovy is based on, that doesn't address. So that's why, even though you wouldn't think necessarily the stock would be up on this, it seems to be up. By the way, this is another very shorted name. So again, it was up something like 20% yesterday, and it's up again today. Could also be some short squeeze going on.
Yeah, we did get some numbers from them as well, too.
Yes.
They did report Q3 sales that beat handily.
Yeah, exactly. And then let's talk about Atlassian as well. Those shares are rising. That company surpassed Wall Street's expectations on the top and bottom line in the first quarter. This is an enterprise software company. KeyBank, by the way, also upgrading the stock to overweight, saying the expectations were high going into it, and it cleared those expectations. This is a cloud-related company here, and the analyst over at KeyBank said that the cloud beat was impressive.
Yeah, this is one, stock has not worked this year, but the street is broadly bullish. Better times ahead. They're betting on Morgan Stanley, for example. They like this one. So the results position the company, say, to head into the forward fiscal year with accelerating revenue growth and expanding operating margins. They told their clients a solid recipe, Julie, for strong stock performance.
Yeah, a lot of price target increases in addition to that KeyBank recommendation increase.
All right, well, coming up, we are setting sail and taking a look at the best ways to be positioned among cruise stocks with today's investor playbook. Stay tuned, much more market domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Royal Caribbean and Norwegian Cruise Lines beating third quarter earnings estimates this week. With other pockets of the travel industry struggling, how can investors take advantage of opportunities in the cruise line space? We are navigating how to play the cruise lines with the Yahoo Finance Playbook. And joining us now is Lizzie Dove, Global Investment Research Vice President at Goldman Sachs. Lizzie, great to see you.
Great to see you. Thank you for having me.
Why don't we start, just kind of big picture with those names that did report. When you look through those reports, Lizzie, what were some of just your earnings takeaways there?
I think there was three main things that we learned. The first is that trends are accelerating. You look at Norwegian, net yields went from 6% in the second quarter to 9% in the third quarter. So trends are getting better. Secondly, new to cruise is expanding, and that is key because it's category expansion. It's not about pent-up demand. And three, the long-term outlook was better. So we've heard about low to mid-single digit net yield growth for next year. They're talking towards the higher end of that. So that was a really positive update.
What is driving all of this, in particular the new to cruising, which is interesting to me? And who's the demographic who's coming to cruising? Is it sort of like the traditional older cohort who's retiring and taking a lot of cruise? Is it younger? What's going on there?
So I'll give you a great stat. Only 5% of Americans go on a cruise every year. Compare that to the 10 to 15% that go to Orlando or go to Vegas. There's a long runway. And to your point, there's a couple of things that are happening. The product is newer, and so there's these new ships that are targeting families and they're targeting younger demographics. So it's cruise lines that have water parks on there, they have mini roller coasters, there's these party cruises that go to and from the Bahamas. There's private islands that they have. So it's a new and innovative product, and it's really bringing in that new demographic.
And Lizzie, if you're a family and you're looking to take a vacation, is it still, is it more financially attractive to go on a cruise than your traditional land-based vacation?
Absolutely. So the pricing gap now, depending on the brand, is anywhere from 20 to 40% cheaper to go on a cruise than it is on land-based. So if you look at what Hotel RevPAR has done over the last couple of years, it's up over 20%. Cruise, it's been good, but not that good. It's only over about 10, 12% roughly. So there's a really long runway to go to improve that pricing and catch up to land-based vacations.
Is it really that? I'm always shocked when I hear this. And I know the cruise lines like to talk. We've talked to them and they've talked to us about this. I mean, because you're not just paying for the room, obviously. You're paying for the food. There's lots of opportunities to upgrade. So, sometimes the price of that, you take day trips, the price can creep up. So even with all of that there's still that gap?
It is. So when you talk about that 20 to 40% stat, that is all inclusive. That's when you have your food and drink included. It's compared to, a comparative vacation like one in Mexico or in the Caribbean, those kind of all inclusive. Now, of course, yes, you can add on, but you can technically go on a cruise, you can keep it 40% cheaper than a land-based vacation. But you touch on an interesting point on the growth story, because onboard spend has also ramped significantly. And almost half of that is booked before you even get on the cruise. You book your alcohol package, your excursion, whatever it is. And so customers get on the ship feeling like they have a fresh wallet. So that has been a driver too.
Let's get to some picks, Lizzie. You say CCL.
Yes.
That would be your top pick for 2025. How come?
That is my top pick. There's several reasons. I think the biggest piece is they have been doing a really good job, but there is a huge catch-up opportunity for Carnival. Several reasons for that. Firstly, they skew most new to cruise. So their new to cruise passengers are growing almost 20% every single year, and that number is getting bigger. Secondly, they have more European passengers, which have been a little bit slower to recover, but are now coming back in droves. Thirdly, they also have a lot of exposure to these new private islands. So they're building one called Celebration Key next year. That is a game changer. And finally, single biggest important thing that is underappreciated about Carnival is that the delevering story. The debt to equity value creation, they're delevering by 2 turns in less than a year. And so you get that long-only investor base more and more interested because the leverage is palatable now. And that's getting that stickier capital involved is really going to be key.
Well, let's talk about the other two big ones briefly here, Norwegian and Royal. They're trying to delever to some degree as well, right?
Yes, so Royal is already there. By the next quarter, we are very, very likely to get a big buyback announcement. They already reinstated the dividend. They're already at pretty much investment grade credit. So they're already there. That story has played out over the last year. Norwegian is a little further behind. And part of the reason for that is their supply growth. So the new ships that they have, they're really building that up. There's new ships, more than one ship coming every single year. So it's just going to take them a little bit longer to delever.
How do you think, Lizzie, about, Royal has had such a strong, 60% this year.
Yeah.
But you obviously, you obviously think valuation's still attractive.
It is, so it's interesting. It's been on an absolute run, justifiably so, but really none of that has been valuation expansion. It has all been the numbers are getting better. And what we learned earlier this week was that the long-term outlook is even higher than people thought. So what they said is EPS next year will have a 14 handle on it. That is just the starting point. And they said, here's all the different ways that this can have upside. So with the private island, the new ships, with buybacks, refinancing. And so there's so much more upside. And the valuation is still trading below 2019 levels. And this is a better company today.
Lizzie, great to have you here. Thanks so much for stopping by.
Thank you.
Appreciate it.
Thanks.
All right, while we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. Let's take a look at where the major averages ended the day and the week. And happy November, by the way, as well as happy Friday. So first of all, taking a look at the Dow here, we got a gain of about 0.2%. That's up 288 points. Of course, the big macro market moving piece of data today was the jobs report, coming in with a gain of only 12,000 last month, even as the unemployment rate was at 4.1%. Economists on balance calling this a noisy report because of the effect of strikes as well as the hurricanes. So expecting, it seems as though the consensus is pushing towards the Federal Reserve cutting by 25 basis points at its meeting next week. All of that said, we saw all three major averages in the green here. The S&P 500 up 0.4% by the end of the day. The Nasdaq up 0.8%. And taking a look at the week here, we did see the Nasdaq fall on the week on this kind of mixed reaction to what we got from large cap tech. Looking at the S&P 500 on the week, also lower. The Dow on the week lower but not by as much, because it is not as weighted, of course, towards large cap tech. Something else we've been talking a lot about is the movement in the 10-year yield continuing to move up, even as we have these expectations for the Fed to cut. So normally it would be going down. Economists, market participants have talked to us about how perhaps that is a factor of the longer term economic outlook and it being relatively positive. Finally, quick look at what we saw from large cap tech on the day, with Amazon finishing the day 6% higher, Apple down by 1.3%. I'm just going to take a quick look at this on a weekly basis as well, as we see a mixed picture there, with Microsoft, of course, lower on the week, Tesla off on the week, 7.5%. Josh?
All right, Julie. The market kicking off the new month with gains as investors look past that disappointing jobs report. And joining us now is Michael Darda, Roth Capital Partners Chief Economist, Macro Strategist. Michael, it is always good to see you and have you on the show. Let's start with that jobs report, Michael, because listen, we thought it was going to be noisy. It was noisy, but it does seem like investors are willing to look through it. What did you make of that jobs report?
No doubt. Thanks for having me on. As Julie just mentioned, very noisy. What the BLS said was that, these storms, Hurricane Milton that slammed into the Gulf Coast of Florida here, right where I am, certainly distorted the number, depressed the number. They didn't have a numerical calculation in terms of what that meant, but we know that it pulled the headline figures down. So we actually had negative private sector payroll growth and some downward revisions, but the prior month was so strong, and not all of that was revised away. Most of it's still intact. That I think markets are kind of just looking through this number, especially since some of the higher frequency data, first-time jobless claims in particular, we got a bit of a bulge there with the storms. That's now been fully reversed. So on a year-over-year basis, first-time claims have receded, all the way back to the zero line. And so I think that's giving some sense of confidence that, that the labor market is still intact here.
So what does all of this mean for the Federal Reserve next week, do you think? Are you in the sort of quarter point cut in November, quarter point cut in December, or do you think there's still some sort of things that could make things a toss-up here?
Yeah, I think, next week they're going to move forward with a quarter point cut. The markets are still priced for that. I think the question is, how is the Fed looking at this bond market volatility, which has been pretty incredible? We have the 10-year yield up more than 70 basis points now since mid-September. So that's a big move higher. And, I think that's been driven by a couple factors. Today's employment data was weak, but distorted. The previous report, as I mentioned, was much stronger. So that really was associated with the first leg up in bond yields. And then, we just got a Q3 GDP report. And the tracking estimates for that had been rising pretty steadily as bond yields were moving up. And, as it stands, just below 3% for Q3, most of which is going to be productivity growth because hours worked were flat. And so, that's caused a repricing in the terminal Fed funds rate. So the markets are still expecting the Fed to cut next week. But the expectations for where the Fed funds rate will land in 2 years have actually moved up over 100 basis points. So now markets are looking at a terminal policy rate, 3.6, 3.7 instead of 2.8, 2.9. And so that's really what's going on here. It's not, people are talking about, well, inflation expectations are going to get away from the Fed. They should stop easing altogether. This move has actually been driven by real interest rates and the term premium. We can decompose the bond yield by looking at the TIPS market. It tells us how much is the real rate and how much is the inflation component in terms of rates moving around. So 2/3 of this rise has been driven by real rates. And some of that's on the back of economic optimism. And then, I mean, let's face it, we have to talk a little bit of politics here. We do have an election coming up next week. And I think there are rising expectations that a red wave could create somewhat of a fiscal blowout, and concerns about the deficit are on the rise, and that would tend to feed into higher real rates as well.
On that point, Michael, neither candidate wants to address this company's fiscal challenges, right? Exploding debts and deficits. I mean, just to put some numbers on this, Committee for Responsible Federal Budget says Harris, her plan increases debt by $3.95 trillion through 2035. By their math, Trump increases the debt by $7.75 trillion over the same period. My question for you, and you're kind of the perfect guy to answer this, if you're an investor listening to this, Michael, right now, you're a long-term investor, against that backdrop, what is your advice? I mean, how do you think about committing capital, stocks, bonds, commodities? What does the playbook look like?
Yeah, it's not a very positive fiscal outlook. And unfortunately, the two candidates for presidential office do not have credible plans, just a bunch of ready ink, a lot of promises that aren't paid for. And, so gridlock really doesn't solve this equation either. We have gridlock right now, and the fiscal deficit is 7% of GDP at relatively full employment, which is ridiculous. Keynes never advocated for that. He said the deficits are, the time for deficits are during the slump, not during the boom or during full employment. And so we're in uncharted territory here. The problem in terms of investment allocation based on fiscal estimates is that we don't really know what the timeline is here. Markets could have a bit of a tantrum, and then policymakers could start to shift their focus a bit. And, that's not a prediction, but, we certainly are on an unsustainable path, but no one really knows what that level of debt to GDP or the level of the fiscal deficit is that really starts to create problems. But we do know now that there is upward pressure on real rates. It is being driven by a repricing of how much the Fed's going to be able to cut rates. Some of that is economic optimism, but some of it's probably also the fiscal outlook as well. I think most of it has to do with the economy. So my advice would be don't radically restructure your portfolio based on estimates of the fiscal path for the U.S. I would say a balanced approach makes sense. What we've been advocating is more of a barbell structure with defensive categories on one side in the event that the economy loses momentum and recession risks flare, and then cyclical value that's really underperformed with the AI craze that's been going on and frenzy. Really those stocks have left everything else in the dust. So for a longer term investor, there is value in value, a bit of a redundant phraseology there. So that would be my approach. And then, I guess for some, it's fun to talk politics and watch the election results, but probably not a great idea to do a radical portfolio restructuring based on that.
And, traditionally it hasn't had that much effect one way or another on people's portfolios. But Michael, I want to, you've been talking to us for a while about the barbell approach and sort of being prepared for the worst on the one side that you talked about, the defensive characteristics. What are you seeing right now in terms of that recession probability, right? Because you've I know that you've been looking for it this year. Where are you right now in terms of how likely it is, and what would be sort of your economic indicators you would be pointing to that would be taking you in that direction?
Yeah, absolutely. So I think we have a pretty high level of uncertainty right now. We're going to need a bit more data. as we came into the summer, the unemployment rate was moving up in a way that you've only seen at the end of business cycles before, right? We got up to 4.3%. It doesn't sound like much, but from a cyclical trough of 3.4% last spring, that's an intense move that is unseen in the historical data set outside of the economy starting to fall into recession. The last several reports, we've seen a pullback. We were just flat on the unemployment rate for October, and that data comes from a separate survey that the BLS told us wasn't really influenced by the storms. So, that is actually atypical. For business cycles, you usually don't see the unemployment rate push up 0.5 or 7 to 9 tenths. We're up 7 tenths from the cyclical trough now, and then start pulling back. So this is a little strange. I think we're going to need more data. Some of the macro data released looks fine. GDP obviously looks very resilient. We've had a nice productivity rebound, but more of the cyclical areas, still look soft. We got an ISM report today, not a very good figure there, 46 in change on the headline number. That's typically something associated with very weak GDP growth, around 1%-ish or so. So there's been a bit of a decoupling in some of these economic series, and I think there's a fair amount of uncertainty there. So my view would be we're not out of the woods yet on those business cycle risks. I would watch the data, and in the meantime, what do you do with your money? I think you address that uncertainty with a barbell approach, especially considering the fact that equity valuations are elevated. It's not a great market timing tool, obviously, but with elevated equity valuations and very high expectations for earnings growth, if we do end up seeing disappointments over the economy, business cycle, deficit, it could be any kind of a shock. We could have more of a corrective undertow start to hit markets. It's been a while, right? We've had a 2-year straight up market, but corrections and bear markets do happen. We had one in 2022. The S&P 500 fell 25% in 10 months. And, it's essentially forgotten now because we've gone, straight up. And basically, the valuations have carried this market. So what's happened is, just very modest earnings growth, but valuations now have fully reset to where they were at the end of 21, early 22. So it's almost like 2022 didn't happen in terms of the valuation compression and obviously the market turbulence. But we know that, you don't have a sustainable year by year, 20+% surge in equity markets with no interruption. That's just not something that you ever see in a historical data set. So not possible to completely time, but I think, with elevated valuations, high levels of uncertainty, I would mix up the cyclicals with some defensive positioning as well here.
Yeah, a little safety in your back pocket. Michael, thank you so much. Good to see you, and have a great weekend.
Thank you. You too.
Thanks. Coming up, candidates on cannabis, or at least what they say about it, why the marijuana industry is set to fly higher regardless, perhaps, of Tuesday's outcome. Stick around, more market domination overtime coming up. Well, whichever candidate prevails this November will immediately become the loudest voice in a fierce tax debate set to consume Washington in 2025. Joining us now with more, Yahoo Finance's Ben Werschel. Ben, we've been talking a lot about what this could mean for taxes. So what is it going to mean?
Yeah, we've been talking about it for a long time, and we're going to be talking about it for a long time, because these are about tax cuts that expire at the end of 2025, so a little over a year from now. And as you mentioned, whichever candidate prevails will be the kind of at the center of this debate. There is one area of bipartisan agreement between Trump and Harris on this, which is that people that make under $400,000 a year should see those tax cuts that were first signed into law in 2017 extended. So that presumably is an area of agreement between the two. But that on itself cost $3 trillion over the coming decade. So that's not cheap on its own. And then each side has a variety of add-ons. Trump has promised somewhere in the neighborhood of 11 additional tax cuts that he wants in there. There's a lot of skepticism about whether they would go in. Harris has had ideas like the child tax credit, the earned income tax credit that she wants to expand that would go in there too. What it kind of comes down to, based on experts I've been talking to, a lot is pretty obvious, but is Congress, is that basically a sweep on either side kind of opens the floodgates, but divided Congress immediately sort of narrows the agenda a lot. So this under 400,000 I'm talking about is on the table kind of in any scenario, but the question is how wide do they go after next Tuesday?
Ben, great to see you as always. Have a good weekend.
Okay, thank you.
Yahoo Finance is spending the final days of the 2024 campaign examining key economic decisions that, like it or not, will confront the next president. For an even deeper look at all of the financial issues that matter most to your pocketbook, check out Yahoo Finance's interactive guide to the 2024 election. Well, the election is now just days away, and while it seems like Vice President Harris and former President Trump don't see eye to eye on just about anything, there is actually one surprising topic where they seemingly do agree: cannabis. And joining us now is Emily Paxia, co-founder of Poseidon Investment Management. Emily, it is always good to see you. So it is interesting. There does seem to be some common ground between Democrats and Republicans on this issue. Because of that, Emily, would you expect to see kind of just general positive momentum for this industry, sort of regardless of who moves into the White House?
Yeah, it's actually one of the most interesting setups I've seen since I've started investing in cannabis in 2014. To see two candidates who could not be further apart on most issues aligning on this one issue, I think is finally showing about how the electorate's will to see cannabis as a legal resource in the United States is finally reaching the lawmakers and at the highest level of the executive branch in this instance. The latest Gallup poll shows alignment on this issue at about 70% approval rating to legalize cannabis. And so hearing these two candidates speaking out in some detail about how they would like to see this happen if they should become president is very reassuring.
Emily, at the same time, the stocks don't seem to be pricing this in, right? When you look at least marijuana stocks as collectively. So what's the gap between legalization and profitability, right? For example, in the Canadian market, we've seen the legalization. You haven't necessarily seen the level of profitability that investors would like. So how should we be thinking about it for here in the US?
Right. There's a few distinctions around why I think the stocks are lagging on such good news, really, such as having two presidential candidates speaking in favor of our issue. The first is purely a structural issue around being able to trade in the U.S. Cannabis names, and that's because we do not have custody. Banking reform, specifically commercial banking reform and capital markets language, would change this. It would change the access and liquidity around these names. And I think you would see responses that differ versus what you're seeing today, where most people cannot participate in our public markets. Whereas what happened in Canada in terms of the profitability of the actual fundamentals of those businesses, they're just extremely different than the US companies that we look at. I mean, you could look at a company like GTI, which is free cash flowing. They have a really strong balance sheet. They're expanding into new markets. You see other companies that are resolving their balance sheets, getting shored up so that they have time in order to execute on their strategy despite the lack of capital flowing into the industry. And so I think in that instance, you just see very different actual qualities in the companies of the Canadian operators versus the U.S. operators that we would consider to be the top names.
One of the things you mentioned there was safe banking, right, which would allow more investor access potentially to some of these names. The president isn't necessarily going to get that one over the finish line. It's going to matter what the composition of Congress looks like. So how are you thinking about that? And is there bipartisan support on the congressional level to get that through?
There has been support, bipartisan support. For example, Senator Daines is one of the biggest champions of banking reform. He's a Republican from Montana. I think that we shouldn't overlook our allies on both sides of the aisle who are just looking for pragmatic reform on this issue. I think the relationship of the president to Congress is just really that's ostensibly the leader of the party. And so if there are stragglers on either side of this, I think that having a president that's supporting reform, especially just, again, pragmatic banking reform to increase transparency and access, I think is something that we could see trickle over to that branch of government. The other thing we have in pursuit, I know we've spoken about in the past, is that Boies Schiller is bringing a case against the government around the overreach of the CSA, interfering with intrastate commerce and companies running legally within these states. What is really exciting about that path of the judicial push is that we got a hearing date sooner than we had anticipated. And so that's December 5th in Boston at the First Circuit. And so we're really excited about that case pushing forward because we're just pulling all the levers we can to put protections around these businesses. And from what we understand, reform like that, you could look at an analog of DraftKings, the case in 2018, and what has happened with sport betting and that DraftKings was able to list publicly, things like that can structurally change how these businesses are accessed and how they can raise capital. I think those are the levers we're looking to pull. But yes, safe banking, something we're hoping to see revisited, but we'll have to see the new construction of the Senate and the House.
And Emily, legalization is on the ballot. Correct me if I'm wrong here. It's Florida, North Dakota, South Dakota. How do you see that playing out?
Oof. Florida, has a difficult hurdle rate. You have to get over 60% of the population to vote in favor of a citizens initiative, and then it has to go into an implementation process. We're hopeful. It's been polling strongly. The poly market information is such a new, interesting kind of dimension of data around these elections. It has been polling strongly. We're very hopeful that it goes because it is a massive market, both in terms of residents, but also in terms of tourism. And it has a vibrant medical market, which tells me that people would like to see it legalized there. So that one's going to be a real nail biter, but we're hopeful that that carries on. And it is interesting because it's a citizens initiative, which means it came from the ground up of what the people of Florida would like to see in place. Now, Ron DeSantis has recently been using taxpayer dollars to go against a citizens initiative. I think we all have. We're disappointed to see that kind of action by a leader going against his own populace, but we'll see what happens from there. And then the Dakotas are interesting just because then we're going to be tipping over in terms of the number of markets that we have having legal cannabis. And this is one of the discussions we're having when we're thinking about scheduling cannabis, about banking reform, is have we reached this critical tipping point where so many people have access to legal cannabis that it just deserves to have the support of any other industry for transparency and regulation. So all eyes are on these different states, and they're important for different reasons.
We'll be watching all of this stuff very closely. Emily, love talking to you about this. Really appreciate you joining us.
Thank you for having me.
Thanks. As we've been talking about, the presidential election is just around the corner, followed by a new administration in the coming weeks. And companies have the task of navigating new leadership in government, and they have to be aware of the risks. Luke Hartig, Gravity Research president, joins us now to map out the potential effects of a Trump or a Harris administration. We've been talking, obviously, a lot about this, Luke, and you're sort of offering a guidebook for companies to try to figure out how to navigate a potential Harris or Trump administration. So help us map it out. Let's talk about Kamala Harris first, and what are sort of the top risks that companies need to think about in, the initial days of her administration, say?
Yeah, this is really interesting. We recently surveyed a number of top executives at Fortune 1000 companies, and we asked them about the risks that they felt from a Trump administration versus a Harris administration. And the risks they feel from a Harris administration are kind of the traditional business regulatory risks, right? Overregulation, taxation. What we hear from a Trump administration is they're concerned that he would somehow reignite kind of the culture wars around major societal issues. So if we're thinking about Harris, the first big thing to watch out for is economic populism. She, as well as President Biden, have gone after companies and labeled and pinned the blame on them for things like inflation, right? Shrinkflation and price gouging and other components along these lines. So we could expect some significant action from her to crack down on some of those things. Now, she has not been quite as hard charging on this as President Biden has. She's not calling out companies by name in the same way that he has been, but it's very much a risk there. I think it actually leads into a broader risk, which is regulation of companies in general, right? And we could expect to see this on a number of different areas, certainly around kind of pushing the limits of the Supreme Court Chevron deference decision and how far can the executive branch go in regulating business. Climate and energy issues, we could certainly see a continuation and an expansion of some of the regulation of the last administration. And then certainly some of the issues that she's really pinning her campaign on, things like reproductive rights, drug pricing, and things of that nature. The final big one, I think, is just DEI, right? The historic nature of her candidacy means that there's already a lot of conversation about DEI provoked by Kamala Harris being in the race. There are certainly things she could do as president that would advance a DEI agenda. And one of the things that we've seen is just the rise over the last year in particular of some really well-connected conservative anti-DEI activists who we think would just be all the more energized and perhaps inflamed in a Harris administration.
And you point out, Luke, too, that understanding how presidents operate is key. It's critical as well. And specifically, you talk about, listen, you got to understand the increasing reliance on executive orders.
Exactly. Yeah, no, this is something we've seen across administrations, sort of the growth of what some have called the imperial presidency, but this is across administrations. If Harris wins, she almost certainly will win with a divided Congress. There's not going to be a lot of room for her to pass legislation because she probably won't have the Senate, and she may or may not even have the House, right? Likely to have the House, but it's unlikely that she would have a clean sweep. So the need to rely on regulation would be essential to getting her agenda through. And there's a lot of things she can do in that regard, right? Certainly the EPA gives a lot of opportunities. Department of Labor could be a vehicle for advancing some of her DEI policies, for example. And you can go on down the list of different regulatory agencies. The last couple of administrations, we've seen in the first, between Biden and Trump, within the first 100 days, passing dozens of executive orders. Some of those are executive orders that would undo their predecessors' efforts. We wouldn't expect to see much of that from Harris, since she'd be following on Biden's footsteps. But certainly that use of executive power is something that's been on the rise, and I think we would look for, especially in a Harris administration, and quite likely in a Trump administration as well.
I want to talk about one of the top risks you've pinpointed for a Trump administration, which is the reigniting of the culture wars. Now, would this be sort of more a halo effect from the administration, or do you think there are actual measures that a President Trump would put in place that would also fan the flames? And then why is this a risk for companies?
Yeah, for sure. So I think the number one issue that I'm looking at in this regard is the DEI agenda, right? And when we talk to our clients, when we serve 80 of the biggest companies in the world, and we ask them right now, what's their up at night challenge when it comes to corporate reputation? The biggest thing they tell us that they're concerned about is DEI and these assaults on DEI that we've seen over the last year or two, which are legal in nature, which are social media in nature. The Robbie Starbuck targeting most recently being the one that's really front of mind for people. With President Trump in office and controlling the levers of government, there's a lot he can do to make it much harder for companies to implement DEI efforts. And we know that this is really important. It's really important to the employees of a lot of companies. For a lot of companies, it's essential to their consumer base. It's certainly helpful in recruiting employees. Company executives themselves have very strong beliefs in the need to diversify their companies. So the ability to kind of roll that back, I think, would be substantial. There are other things that don't impact companies quite as directly. For example, action that we could see on abortion and reproductive rights, action we could see on Title IX, gender protections, et cetera. And while those may not impact companies directly, they are the sorts of things that we've seen that employees really care about. And companies consistently tell us that the number one source of pressure that they feel to engage on societal issues comes from their employees. So you can imagine a number of scenarios where a President Trump puts in place policies that affect societal issues, that sort of inflame those culture wars, and lead to employees saying, hey, you have to stand up for us because I work at a place that I believe represents my values. And that'll create a real conundrum for corporate leaders.
Luke, thank you so much. Interesting stuff. A lot for executives to consider next week. Thank you.
Thanks for having me.
That'll do it for today's Market Domination Overtime. Be sure to come back on Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
And don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Stocks jumping to start November as tech leads the way on Wall Street. Investors shaking off that weak jobs report and focusing on tech earnings. We're taking a look at the takeaways from the trading day that's straight ahead. Plus, a closer look at the state of sports sports betting. It has been a busy week for the industry between the start of the NBA season and the World Series. The CEO of BetMGM is here. And New York City is gearing up for the marathon this Sunday. We're going to be checking in on with the official timekeeper, luxury watchmaker Norcane, what the company is seeing from the high-end consumer. That's straight ahead. Well, markets closing higher to end the week. That's ahead of next week's presidential election. And Yahoo Finance's Jared Blickery joins us now with more on the trading day takeaways. Jared.
Why, thank you, Josh. Well, the first one is Magnificent Seven. They are divided. That's maybe nothing new, but we saw this week more evidence of that as some of these big tech earnings came rolling in. And let's get to a heat map where I have a bunch of Mag 7. These are the mega caps in general, about 12 of our biggest stocks, plus Bitcoin. I threw it in so you could see the market cap comparison. But let's just pull up some of these charts here and show you what happened to some of these longer term patterns. I'm going to show a year-to-date chart here, but I'm going to show you how this week's price reaction has really meant something to some of these longer term trends. First of all, Apple was in a trading range and it is now sold off from the top of that range. That's the basic development from this week. Now I'm going to show you, let's do in Microsoft as well. This is a company that was in the middle of a very large trading range and now has sold off and probably going to head down, maybe test this support down here. Looks like it almost met it, maybe go down here. So this is a little bit more work to do for Microsoft. Alphabet is really interesting. We saw a bullish move this week off of earnings and it came back down. But guess what? It's only testing the prior breakout level from this inverse head and shoulders pattern. So that is still leaving us with a little bit of bullish momentum. And then Amazon. Finally, Amazon looking really interesting. Came all the way up here after that negative day. This has been a volatile week for Amazon, but came all the way up here, testing this level, hasn't been able to break through quite yet. Here's a 5-year chart. Within this context here, we can see this giant cup and handle. I think when it finally gets started, we'll see liftoff here, but not quite yet.
So we talk about big tech, by the way, Jared. Yeah. Market concentration, still a risk for investors?
You know, really interesting. I just saw a stat today on market concentration. If you take the top 10 stocks today, so that's going to include the Mag 7 plus JP Morgan, Berkshire Hathaway, we're actually more concentrated now, 37% than we were in 99. That was a dot-com boom, than we were in other prior eras. So we are actually more concentrated now. Don't know what to tell you, but we are.
All right, Jared Blickery, point number 2.
All right, number 2, we got some election jitters. And when I say jitters, I'm thinking about the VIX in general. And you might be thinking, well, didn't we have very low realized volatility recently? Well, that is the case, but I'm talking about implied volatility. And let me just show the VIX. This is a 3-month chart of the VIX. Let's dial this down to a 2-month. Now we see we just had this big spike up, kind of met these prior highs, so nothing too big there. But I think it's really interesting because we did have such low actual volatility in the market. And just as a reminder, the VIX is forward-looking volatility. That's projected volatility as expressed through the option market versus what we're seeing in actuality. Now here's the ICE B of A move index. That has been doing nothing but moving higher. What this measures is volatility in the bond market, and that is even higher today. Got to show you what happened with the 10-year T-note yield. That is up to a fresh high, so that's a little bit concerning. Sometimes these expressions of volatility, they just spill over into risk markets. These higher interest rates, they can spill over into risk markets. We didn't see it today, but that might be something on the horizon here.
All right, Jared Blickery, point number 3.
All right, let's get straight to that. And here we have, there we go, Bitcoin is backing down. You know, it's a weekend time, so we got to talk about something that's moving over the weekend. But what do I mean by backing down? Bitcoin has simply retreated from one of its highs. And let's see if we can pull up Bitcoin here. Here we go. This is a 2-month chart, but let me show you the year to date so we can see. There we go. And I'm going to put some lines on. Came all the way back here. This is a record high. We did have this negative trend channel in place, broke out, but we have not been able to eclipse what are these horizontal resistance levels. So we're still in this giant trading pattern. And what did I say? What have I been saying for the last few months? It doesn't really mean anything until we break out. But let me show you what could happen when we break out, because we have the election just around the corner here. The past two prior elections, we have just shot up afterwards. So when we talk about election year seasonality, it has to do with Bitcoin as well. And this is just a very long-term bullish pattern that we're looking here. And the latest consolidation, all that consolidation I was showing you before, it's just right here on this 3-year chart. So if we can break above, probably easily have 100,000, 125,000 in sight. But again, we have to see that catalyst.
All right, Jared, thank you, buddy.
You got it.
Appreciate it. Stick around. Much more Ask for Trends still to come.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Sports betting platforms active in New York are smiling today. That's because in the week ending October 27th, mobile sportsbooks generated a staggering $576.1 million. That is the highest since wagering went live in New York in January 2022. Now, despite the success, platforms still trying to avoid customer stagnation, fend off competition not only within the space, but also from other platforms like Robinhood and Kalshi. And joining us now to discuss all this is Adam Greenblatt, BetMGM CEO. Adam, it is great to see you and have you on the show. Want to start kind of high level, Adam, because you all have been, investing in this business. Walk us through, that investment, what you've been investing in, and what the returns have been like.
Yeah, that's a great place to start. Thank you for having me, firstly. So we've been investing principally in establishing our footprint, establishing the quality of offering. So it's product first, and then team. We have around 2,500 BetMGMers worldwide. And then, of course, big investment in player acquisition, which has been the primary area of investment since we've launched, actually. Returns have been stellar. We're on track to deliver well north of $2 billion of revenues this year. And we had a profitable third quarter. So really pleased with the progress we're making in 2024, which we've assigned as an investment year for BetMGM.
And Adam, what differentiates you all from the competition? How is your experience different?
Yeah, so one of the things that does separate us is our relationship with MGM Resorts. MGM Resorts and all of its brand heritage, we see ourselves as the sportsbook born in Vegas with all of the premium qualities that MGM Resorts embodies. So we also bring to our players an omni-channel experience. So if you join BetMGM, you are signed up to MGM Rewards, you earn BetMGM points, which basically reduces the cost of your next trip to Vegas, which is unique to us, of course.
Adam, let's talk about the NFL as well. I'm just curious, we're in full swing here. How is this season different, if at all, Adam, from last season? Just are betting patterns different, bet types, bet mixes? What are you seeing?
Yes. So what we're seeing more broadly in the sector is a move away from what was the Vegas six-pack, if you like, which was the combination of bets around game total, game spread, outcome spread, and the money line, i.e. who wins. So it's really diversifying into prop bets and different kinds of more exotic bets. And just to give you support for that, on an average NFL game at BetMGM, you can wager 450 different kinds of ways on every single game, and on the futures market, over 1,000 different betting opportunities. So really a diversification of offering. Other things we're seeing, the Caitlin Clark effect has introduced more women to betting. We're seeing a significant increase in women's participation and women's betting on women's sports. That's another trend we're seeing this year.
And MGM, Adam, partnering with Marriott now, have you been able to add incremental customers because of that?
We have. We've had a very successful start to the season, and our relationship with Marriott we're really pleased about. And in fact, I referred to the loyalty points, that you can also redeem your loyalty points for night stays within the Marriott portfolio. So we've seen a good uptake of players linking their BetMGM accounts with their Marriott accounts, and so that's been a real help to our business this year.
Adam, great to have you on the show. Appreciate your time.
Of course, thanks for having me.
Time now for what to watch next week. Election day is finally upon us. The U.S. presidential election between Vice President Kamala Harris and former President Donald Trump is on Tuesday, of course, while all eyes will be on who will become the 47th president of the United States. Many investors will also focus on who controls the House and the Senate. And before you can catch your breath from the election, the Fed's interest rate decision will be coming on Thursday. Fed Chair Jerome Powell will be holding a news conference following the decision at 2:30 p.m. Eastern. Yahoo Finance's coverage on Thursday is going to begin at 2 p.m. Eastern. And finally, the earnings train keeps chugging along. We're going to be hearing from Palantir, Novo Nordisk, and Qualcomm, among dozens of other companies throughout the week. Palantir announcing results for the third quarter on Monday. Analysts focusing on the company's commercial segment for Q3, saying that momentum hinges on its artificial intelligence platform boot camps. Well, stay tuned. More Asking for a Trend right on the other side. Norqain, a Swiss watch startup, is creating a foothold in the luxury watch race, including a partnership with the New York City Marathon for the third year in a row. Our next guest, Ben Kufer, is the founder and CEO of Norqain, and he's also running the marathon for the first time this weekend. He joins us now with Yahoo Finance's very own Pras Marine. Welcome, guys, both to the show. Ben, talk to me about just the New York City Marathon. How did this partnership come about?
Obviously, Norqain is a challenger brand. We started in 2018 and we're very closely linked to sports. And the marathon is an ultimate challenge. So we said a dream would be to one day be the New York Marathon. That feeling of going over the finish line, absorbing, the best challenges in the world. And that dream came true. We're now the third year the timekeeper and very excited. Running it on Sunday for the first time. So we're getting ready. Thank you very much.
Yeah, I used to be a runner myself, but then not so much these days. But I know that a lot of people that buy your watches are active-minded people, hence the tie-up with the marathon. Is that part of that importance? And also, what are they telling you about what they want with their watches?
Yeah, well, of course, with the Wild one, we have the ultimate mechanical sports watch. We launched it in 2022, and we wanted to really, with the marathon, you want a light watch. And this, the Wild one is 78 grams light. It's ultra robust, and shock absorbing. So the marathon was a great way to show actually, what we're doing at Norqain. We're challenging the market with new materials and sporty watches. So with the New York Marathon, I think it's the ultimate challenge, and I'm really excited to be there on Sunday.
Ben, how do you think your product sort of fits in to the broader watch category? I've seen some folks say they kind of think of you guys as sort of filling the gap in what they say is sort of entry-level luxury segment of the market. Is that how you see it?
We see it in the export numbers, right? We have a record with 26 billion turnover last year, but we're losing in volume. And I think the trend is that watches have become more expensive over the past years, and there is no startup culture in Switzerland for mechanical watches. So the young generation, I thought it was really important to get, innovation, great products back to a price range where people can enjoy it and can actually invest into a mechanical watch and say, I have a great first timepiece.
So looking at the industry sort of overall, I wrote recently about how America was a big focus for the traditional watchmakers because a lot of their business comes from here, and other parts of the world have been dying down a little bit. Do you see that same picture for Norqain in the States?
Yeah, I mean, the US has been great for us, right? When I came here in 2018, as I said, Switzerland doesn't have a startup culture, not a big one, definitely not in the mechanical watch industry, there is none. And I came to the US and people, really encouraged me from the start. They said the timepieces were great, and there's a different culture here for startups. And I think that's really the strengths of the US market for Norqain is really, it's a market that's still growing. It's up 4.9% this year in total exports to the US. So that's the entire industry. We're really lucky. We're growing by 50% this year in the market. I think it's really encouraging to see how people are cheering us on, and I'm really, really happy. So yeah, thanks for the support.
Ben, who is your average customer? Like, what's the demo? Is it men, women, young, old? Like, when I'm on your website, I sort of imagine like it's a young guy, probably also owns a GoPro, loves mountain biking. That was what was in my head. But is that it?
Yeah. I think that is, for sure, we have two customers. I think we managed to find a new watch customer who loves being active, sporty, out there. He's in the outdoors and he wants a robust timepiece, and Norqain is the solution. But we also managed, and I think that's very exciting, to get into the collector scene. So we have those two customers. Just now coming back from Bucher on Fifth Avenue, we had a really good meeting with a great collector who's bought several great brands, and he said he just bought the purple 8K, the new chronograph we launched. Perhaps you were at the launch event. So it's really nice to see we have those two demographics, 80% male, 20% female.
You mentioned, that's interesting, that gender dynamic there, because we're seeing that happen with more younger buyers and more women coming into the market. But I wanted to ask you in particular about how do you compete against the traditional, the Holy Trinity, right? Rolex, Patek, AP. How do you compete against those guys in this market where people want prestige?
I think, Rolex, Patek, Audemars Piguet, these are, the best watch brands out there. They've got a tradition, a history. And for us, that's really the role of Norqain. I think these brands are also at the price point where you are close to the $10,000 and upwards. And I think that's very important. And we see it in the volumes that have reduced, that we have a price offering around $5,000. That's very strong in the industry. So I would say we're there. That's where we see our strong point is between 3,000 to 7,000 in the long run. And I think that's a very good price positioning for a great quality mechanical Swiss-made watch.
Ben, it was so great to have you on the show today. Thanks for joining us.
Thank you very much.
And
See you at the marathon.
Good luck on that marathon.
You're joining me.
That is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.